I'm going to go ahead and get started today. My name is Gabriel Ratana. I'm filling in today for Jason Sipple in your Founding Fathers training weekly call that you guys do. Today, the topic of the presentation is called, the original name is Larry Lucky Jeans. I learned this from my mentor, my money mentor, Brent Kessler, and he's phenomenal at teaching this concept of infinite banking, but specifically this presentation, I learned it from him. And it truly is the gift of a lifetime. There's no better gift that a parent or a grandparent can get for a child or a grandchild than a whole life policy from a mutual company that pays dividends. And like I said, this is one of the best presentations, one of the best trainings that I've ever seen on how to use life insurance and infinite banking. And really, the purpose of IBC is to control the banking function in your life. This is the vehicle, the whole life policy. This is the vehicle, this is the machine to fund all the major purchases in your life and create a system to recapture and recycle all the money that leaves your family. The unfortunate lie that financial gurus and advisors tell you is that you have to invest for things that you probably should be saving for. Parents, say you want your kids to go to college. How can they do that? Well, they can save for it or they can invest for it. Okay, but when you invest for something, that money is going to be at risk. Is it 100% at risk? I'm not sure, but the definition of an investment is something you put money into with the hope that it grows in value over time. But it can also go down in value. There are no guarantees. How would it feel if, your child gets to retirement age, or sorry, not retirement age, college age, and the money, didn't grow the way it was supposed to, or somehow you lost it all in that investment? How are you going to feel telling your child that you can't pay for their college and they're going to have to go get loans or figure it out themselves? Okay. You could, so with investments, you can make money, you can break even, you can even lose money. But what about for our retirement? Well, if you live long enough, your retirement, it's probably guaranteed to happen at some point, or you're guaranteed to need money. Whether you retire or not, that's a whole nother story. Okay. In this presentation, I'm going to show you how to start a policy for a brand new child and how they may use that policy throughout their lifetime. Seeing how the money flows is what really opened up my mind to see just things I couldn't see before. So banks and Wall Street, the financial industrial complex, once you focus on the wrong thing, hopefully after today, you can see the truth and begin to understand how the wealthy play the game. So what you're seeing right now is an illustration of a whole life policy. Okay, there's many different ways to design policies. This is a 10-pay policy. In this policy, premium deposits end after 10 years. The policy is fully paid up after 10 years. So now in reality, we would never want you to stop paying premium into the policy. Okay, I will explain this at the end of the video. Right now, I just want to get into the example. And this policy begins at age 2. For 10 years, the parent or grandparent will fund the policy at $15,000 per year. I don't know if you guys can see my mouse, but the mouse here, age 2, year 1. The next column over is the cumulative premium paid in cash. Okay, so year 1, we're at 15. Year 2, we're at 30. Year 3, we're at 45. The next column over is cash value. So in this policy, when you deposit $15,000, you have $750. This is totally different than the plans that we usually create. Maybe if you guys have seen some other videos with different illustrations that have a lot more cash value in the first couple of years. But this is just an example of how this policy was set up. It's actually a very weak policy, and even still, it is extremely powerful. Okay, so all the way to the right, we have the cash value. And so in this example, 15,000 premium buys them $1.6 million of death benefit. If you notice, after 10 years, the cumulative premium paid in is $150,000, and the cash value is $164,323. Any questions so far? Okay, so this is just a policy that we're paying for 10 years, 15,000 a year, and 150 grand. In this example, we are not using any of the cash value of the money. Okay, he's just putting his money inside the policy and he is putting it on the shelf. He's not using it. And at the Money Multiplier, we teach you to keep the money in motion. The worst thing you can do is just buy the policy and not use the cash value. But as you will see as we go through this example, even if you bought the policy and left it on the shelf for a while, it's still going to be a great thing. All we're saying is the more you use it, the bigger the numbers are going to get. And in year 10, the death benefit has actually grown to 1.8 million. I took this from Brent's presentation, and at the end, I'll show you a little bit of my son's policy. So I made one similar to this one, but like I said, this is a little bit of a weak example because we stopped putting money into it. And my sons, we continue to put money into it, and you'll see why that's good when I go over that. Okay, but remember, these policies, whenever you're starting them, they're not for the short term. You're doing them for the long term play. I had a conversation with someone not too long ago, and he asked, "Well, how about if I decide to pay premium for just 3 or 4 years, and then I don't want to pay any more premium?" My answer is, don't even start. Just throw away all the information that we've given you and literally just walk away. You're not going to be happy if you're only going to want to put premium in 2, 3, 4 years or so and then stop. I'm just going to tell you not to even start. Okay, this is for the long term. At age 18, the child is going to go to college, and in this case, in this policy, it's going to be used to fund the college. We're assuming college is going to cost $20,000 per year. If you notice here in year 20 of the policy, when the child is 21, they've taken out $80,000 of the money, okay, to go to college. Do you see where it says cumulative cash flow received over here? This one, this column, cumulative cash flow received, $80,000 right there. So in this policy, they injected $150,000 in the first 10 years, didn't do anything with it. Then year 17, 18, 19, and 20, they took out $20,000 each year to pay for their college tuition and their expenses. So as life goes on, at age 25, he gets married, and the wedding is going to cost $30,000. I want you guys to look down here, age 25. Do they have enough cash to pay for the wedding? Can you guys see? What do you guys think? Do they have enough cash to pay for the wedding if the wedding is $30,000? Yes, right? They actually have $201,000 here in the 25th year. So now they paid for 4 years of college. They paid for their wedding. So they've taken out 110,000 out of the policy. Now, one thing you've noticed is I'm not putting money back into the policy. We're not playing honest banker. We're not repaying the loans. Right now, we're just withdrawing money out of the policy to pay for these major expenses in their life. Okay. Well, okay. So after you get married, what happens next, right? You're gonna want to buy a house. So 5 years later, they come up and they want to put down payment on a house. They need $40,000 for the down payment. That's down here at the bottom, age 31, year 30. So do they have enough money for a down payment? We have $224,000 there. So yes. So I guess if you wanted to, you can make a bigger down payment, or if you find a house cheap enough, below 224,000, you can pay for the whole thing from your policy. This is called the infinite banking concept. You can really do anything you want with the policy. So we buy the house at age 30, and now we continue on with life. At age 47, now this one who became a child is now 47 years old, got married, has 2 kids, 2 years apart. They've reached college age. And in year 46 of the policy, they have $546,000 in cash value. Okay. College costs went up, and it's now $30,000 per year per child. The first child goes to college, year 46 and 47. That's 30,000 each year. And year 48, 49, they have both kids in college. So that's $60,000 each year. Then 51 and 52, it's the second child just going for those last 2 years. Okay. So what do we do? Between 2 kids and 6 years, we took out $120,000 each to pay for the college tuition over the 4 years, which is $240,000. So look where we are in year 52. Okay. What have we done? We've paid for college for the original child. We paid for the wedding. We paid for the down payment on the house. We paid for his adult children to go to college. Altogether, up to this point, we've taken out $390,000 of cash flow that's come out of the policy. And do you guys remember how much we put in? We put in $150,000. We paid $15,000 per year for 10 years. Well, the grandparent did, the parent did. And then they stopped paying premium. Okay. See some in the chat. Let me see. Absolutely. And at any time, if this person, something happens and they die young, look, there's 3 million, over 3 million now in the cash value. Okay. They funded this thing, and there's ways of looking at it like ROI and different things, but really the benefits of this, it's funding these major purchases in our life. And these are things that are guaranteed to happen. Well, you're not guaranteed to have kids or go to college, but these things are normal planning that we want to, if like, once we're gonna have those things take place, we want to have the money there. We don't want to just hope it's there, right? We don't want to invest for those things and then not have guarantees that the money is going to be there. Okay, so let's look at what happens next. We have retirement. They turn age 65, and in this example, that's when they're going to retire. Are there still people retiring at age 65? I don't know, maybe, but in this example, this is when this individual is going to retire. Okay, they're going to start taking out retirement income from the policy, and what they're going to do is take out 60,000 per year of retirement income from year 65 all the way to the day they graduate. So we're going to kill them off at age 90 in the 89th year of the policy. So how much did it take out in retirement? 25 years times 60,000 is 1.5 million. The total that we have taken out of the policy in the 90th year is $1.89 million. So almost $2 million that we've taken out of the policy. It still has a cash value of 1.1 million. And look at the death benefit, 2.4 million in the 90th year. I want you to see what it says there in yellow, okay? And this is what we call Larry Lucky Jeans. The decision that his grandparent or parent made for him, they started this policy when he was a 1-year-old baby. He was able to pay for college, a wedding, the down payment on their house, paid for college for 2 of his children, also took out 60,000 per year in retirement for 25 years. I don't know of a better vehicle on this planet that allows you to do this with these features and benefits. Now just imagine, you got to use your imagination, and that's what Nelson Nash always said. Use your imagination on these policies because there's an infinite number of ways you can design and use these policies, okay? That's why we call it the infinite banking concept. But what if instead of only putting 15,000 a year, he put in 30,000 per year? What would happen to the numbers? What if instead of stopping the premium payments in the 10th year, he continued to pay premium? Well, how about if you use the cash value, because you notice there's a lot of cash value in there that's just sitting there and not being used. How about they use that cash value for more things that they were going to do in their life anyway, such as purchasing cars, paying their taxes, electric bills, starting a business, vacations, all the products and services he's going to buy anyway. And if he plays honest banker with himself and pays the loans back to his family banking system, just like he would pay a conventional bank, what would happen to these numbers? Okay, they would just be way, way bigger. I can't reiterate this enough. They did not utilize the policy the way we teach to use it. They bought things with it, which is fantastic, but there's just so much more that they could have done. And in this example, we like to underpromise and overdeliver. My oldest policy is in year 6, 7. Honestly, sometimes I lose track. I believe it's in year 7, and the even the non-guaranteed cash values on it, it's much higher than it was in the original illustration, which is really, really cool. So the number's only going to get bigger, and that's not counting the investments that I was able to make with the cash value. Okay, things that I've done is I paid off debt. I use it as a down payment on a house where I live now with my farm. I bought some rental properties that I've used for cash flow and then was able to sell for profit. And most importantly, I use it to start my jiu-jitsu school. Okay. And that's a business that continues to provide cash flow and pays back into the system. And eventually I'll have a self-sustaining system of my assets funding my life. Okay. But more importantly than hold on, is the assumption that each loan interest is paid yearly only, interest and loans repaid regularly, or no payments made at all. In this example, there were withdrawals. Okay, they were not doing loans, or it might have been withdrawals to bases and then loans. I'll have to check and get back to you guys on that. Is the assumption that each loan interest is paid yearly only, interest and loans paid regularly. So that all comes to your preference. With one of my policies, I only paid the interest. I didn't pay back the original principal until maybe 5 years into it. I sold the property, and from the proceeds of that, I used that to pay off the entire loan balance. So I was taking money out every year to invest in some education, acquire more assets, and I used cash flow that came in. I used the cash flow to pay for my premiums. Um, and then once I had a windfall selling the property, I paid off the entire policy loan. That's how I did it. But then I basically took it and used it on something else. So I could have not paid it off, but I always encourage people to at least pay back the the interest. Okay, it looks like in this scenario they never made a payment back on their loans. That is correct. So in this scenario, there was no repayments. Okay, and a way we could make this a little bit stronger is in my son's policy. Okay, they don't stop paying. We don't stop paying at year 10. And the reason for this is the cash on cash return. So when we put in $1 in year one, we have 63 cents available in cash value. This one is because it had a little bit of a dump in, so then it drops to 54 cents, 57 cents. By year six, when we pay in $1 into the policy, he has access to $1.07. Okay. By year 10, you put in $1, has access to $1.29. Okay. At year 15, you see how it keeps getting bigger. In the original example, okay, he, because of the policy contract, he's not able to put in more money into the policy. But I set up my son's policy so he doesn't have to stop paying. And what's really cool is, say in year 70, once he's starting to reach retirement age, when he puts in $1, and I think his premium is going to be 3,000 a year, he puts in 3,000, whatever 3,000 times 2360, that's what he's going to have available that year. So it'll be $70,000 available that year of cash value growth that he can access um, to use. It just continues to get bigger. Year 80 puts in $1 and he has access to $30.50. And then by year, 100, it's just starting to get pretty ridiculous. And when 120 puts in $1, it's $60. So maybe he'll live that long, maybe not, but his death benefit will be there to pass to his grandchildren. So more important than these vehicles we're using is we got to pass down the knowledge of, if something happens to me, I have documents I'm putting together, trainings. A lot of it's to be able to just teach my own son how to take over and learn to put money to work so he doesn't have to work for money unless he wants to. I would love to him to have a business that allows him to fulfill his mission in life, whatever he feels it is. For me, I love working with people, teaching, coaching. And what I'm interested in coaching is the things that I'm just interested in myself, which is jujitsu, fitness. And with my jujitsu school, that's where I get a chance to, help people get in shape, stay in shape, learn to protect themselves, and really learn one of the most fun games that there is, which is jujitsu. We try to choke each other and strangle each other for an hour, and it's an amazing workout, and you'll never be in better shape than as a grappler. So it kind of solves a lot of things in my life. And as the school continues to grow each year, we attract more students, and the ones that like it pretty much stay forever. So we have a very sticky retention rate for the people that actually like to do it, and they pay monthly, yearly, however they want to set it up. But it's a recurring revenue model, which is pretty cool. Who and how do we set these up? Very good question. If just talk to Jason, you should have his contact information. Let him know. Yeah, there you go, Patty. Thank you. Book a call with Jason. If you know people who want to learn this information, only speak Spanish, I can help do a presentation for them. But we have a lot of resources in English, and this one we call Larry Lucky Jeans, but it's just a child policy. The limitations on these is based on how much life insurance you have. Okay, so I have about 3.3 million on my life right now. So the most my son can qualify for is 1.5 million. Okay. At the time where I got him his policy, I only had 1.5 million in death benefit. So he could only qualify for 750,000. That's usually what how it works for the child policies, okay? But with this concept with infinite banking, it's going to be about a system of policies. So once we max out Koa's policy, he'll eventually get some, as an adult. But I'll probably take a couple more policies out on him as time goes on. But I have to take some out on his mom. I'll probably take some out on more on myself. But there's a lot of different options for that. Do you guys have any questions? I've been trying to get the ones in the chat. But this again is just an example of controlling the financing in your life. We're not outsourcing these major purchases to third-party creditors. We have control of whether we want to pay the loans back and in what terms. And because when I first opened my jiu-jitsu school, the money coming in, I didn't have enough money to pay back the policy loans entirely. I could pay back the interest, but I had a lot of bills with, like the rent. I paid off. What I would do, I would buy merchandise like in bulk, um gis, rash guards, those things, with my credit card, and then I would pay off the credit card with my policy loans. So then, as more income comes in the future of them paying their membership dues, I use that to, pay down the balances on my policy loans. Once I pay back off those policies, my plan is to continue to use that money and invest it into marketing so we can continue to grow this thing a little bit faster. Will you incorporate trust to secure future payouts from frivolous spending? Yes, I will. I still don't have a trust. I started looking into asset protection and trusts and foundations, and the honest response from the guy setting it up was like, you need to make a lot more money before you really focus on doing this. So I'm still working on my income generation to then really need to do this. Amy, my spouse, she's learning how this works, but I'm basically teaching her how to do it. My death benefit's going to go to her if something happens to me, and I've instructed her on how to put this into policies in the future. But ideally, with the frivolous spending, I do a good job of teaching my son how to handle money correctly, and then he can, we won't need the trust to enforce the rules. But I've seen it where people have an attorney actually meet with their kids and explain to them the rules. I still have to make those decisions in the future, but I'm not at that level yet where I have that much money. But I guess if I do die tomorrow, it's $3.5 million. I'm just right now, honestly, just hoping, Amy knows what to do with it. I trust her to know. How many policies can you get, and does it work the same with traditional policies where you have to do exams? Yes, it's based on your income. You can't put in more than 25% in premium of your income per year. So if you make $100,000, you can't put in more than 25,000. What you can do though is put in a dump in, which is a one-time additional premium. So the second policy I got it last year. My yearly premium is 15,000 per year. I pay it quarterly, so it's about $3,700 per quarter. And I did a dump in where I was able to put in an extra $100,000 the first year, and that allowed me to use that almost right away. Of the extra 100,000 that dump in, I was able to use about 90% of it, which is really cool. And I was able to use that. Half of it went towards down payment on my farm, and the other half went right into my jiu-jitsu school, right into the business, so I could use that money to pay for operating expenses and for some different things. Okay. Great example of compounding interest over a lifetime. Love that the example shows that you never pay back the policy loans. I would assume the policy absorbs any interest owed. Yes, they've taken out 1.8 million, and each year after, so if you look at the net death benefit, it goes down over here. It's because the interest is compounding, right? So if on the loans, so if they were to pay off those loans, then they would basically have a lot more of the cash value. That's why we always encourage people to pay the loans. But we just wanted to do an example where they could fund all these things in their life just by paying that premium for 10 years. What would you say that following this concept sort of nudge you towards better health habits, since you need to be in better health shape to get more policies on yourself? Yes, 100%. I've always been into wanting to be healthy and fit. My problem was getting injured. I would kind of go a little too hard, so I would go all into working out and getting in shape. But then I also like to play sports. So whether it was basketball, and there's not really football you can do as an adult, but I would get just injured, and then from the injury I'd have to sit out, so I would lose my my being in shape, and I'd have to basically start over. And that inertia of being on the couch, having to start over, is very, very hard. So I took a very similar concept to the compounding, which is just 1% better every day. So with jujitsu, I don't go all out and try to kill myself in training. I go hard enough where I'm pushing myself, and I'm building skills, and I'm getting a good workout, but I'm not destroying my body. You'll see a lot of people who train jujitsu and martial arts, they'll destroy their body and they can't even train anymore. And by just using jujitsu as my guide to train, and I would do the strength and conditioning to support my jujitsu. How can I position myself to always be healthy and always be on the mats? That's what's kind of kept me in shape. And there are jujitsu practitioners like the old school Gracies. Some of them are in their 80s and 90s, still alive, training and living very healthy. But yeah, that's always kind of just been my thing, trying to stay healthy. But if the hack, honestly, with that, and also with nutrition, is you got to find something that you enjoy doing, whether it's walking, going on bikes, but running. I never liked any of those things. I like more like playing sports. But as an adult, it's kind of hard to find sports. But with jujitsu, I fell in love with it, and I would train 3, 4, 5 times a week. When I first opened my jiu-jitsu school, I was teaching about 20 classes a week. So I was basically forced to be on the mats and moving and grabbing people and getting thrown. So you kind of get conditioned to it. So naturally, you end up being pretty healthy. What insurance company do you use? We've used, I have policies with One America for me and for my son. And I also have one with Lafayette Life. We also use SML, Security Mutual Life. If you're a New York resident, we use those. But Jason can go over those different options, and everything we do is case by case. With infinite banking and the way we plan, we want to plan backwards. Like I said, the purpose of this is to pay for the things that we need and want in life, and we want to work backwards from the things we know we're going to have to spend on, right? Whether it's house, cars, college for our kids, or retirement. I don't want to gamble and hope my retirement money is going to be there. I want it to be guaranteed. So some of these products are going to be able to do that for us. Last question. I keep seeing that front loading is most beneficial in IBC concept to get cash out sooner to make money work twice. Since you are limited at initial policy conception with how much you can put in, throughout the life of the policy, is it best to wait until you can front load a good amount? Yes and no. If you have a family, I would recommend at least getting a small policy right away. When I first learned about this, it was 2014. I think I was about 24. I did not have a family. I was single. But I saw the power of this, and I knew I not only do I want to practice this, I want to make a living actually teaching people this idea. But I didn't get started until 2019. So 5 years went by. I did not have a policy, right? If in those years I would have, passed away and I had a child, there or a wife, that none of that, like I would not have been able to protect my income that I would have made and been able to take care of them, right? So just because of the death benefit and legacy piece, it's best to get a policy right away, even if it's a convertible term or a small whole life policy. Okay. The way this is going to work is you're going to run out of space in your policies to put money into those policies. You're going to have to get new ones. So even if you start with a small one, you can get another one within that same year. I've heard Brent say with our company, over 91% of people get a second policy within the first year. Okay, so if you have money just sitting in savings, not doing anything, and you want to move that as a front loading, as a dump in to the policy, that can definitely accelerate not only the cash value growth, but it can allow you to use a lot more. If you're putting in, say, maybe the minimum, if you're 30 and you're putting in like 3,000 a year, just something like that, a minimum to make it kind of work, you might only be able to access 2/3 of that. You might only be able to access 2,000. So what can you use that? Start using that just to prove to yourself that it works. Maybe if you need to buy a computer, an iPhone, finance it with your policy, then pay it back, recapture the money, and get used to becoming your own banker. Now, once you understand the mechanics, you can expand, and those savings are going to compound. And as you have more, start thinking of ways, how can I use those savings to purchase cash producing assets? And when those cash producing assets create profits, then you want to start looking at getting the profits into the policy. You want to be comfortable with your premium, that you can pay it no matter what. And then maybe on the next policy that you get, that extra money that you might have once, but you're not going to be able to get consistently, put it in as a dump in. And then you don't have to worry about, oh, I have to do 100,000 every year. For me, that's a lot of pressure. Okay. I can do, well, mine was pretty high. So it was a like a stretch goal when I made my policy. I kind of went from 2014 to 2019, 5 years without putting in premiums. I didn't have any policies, so I went with like a really big policy to kind of make up for that. But some years it was very hard. I could only pay the base and then make up the PUA later. If you don't know what that means, it's okay. There's just a portion with the policy that you have to pay no matter what, and then there's another portion that if you can't pay it, you can make it up later. We call that the paid up additions rider. It's essentially like we're overfunding the policy with that cash. Okay, and the policy gives us flexibility just in case we have down times, high times in our life, because nothing's going to be perfectly linear. Jason helped me design my two policies. One was a large dump in. The second was designed so I could put additional amount each year over and beyond what I had set it up for. Awesome, Shane. I started with a small policy, no dump in. It's been amazing. Good, Christian. If you have high interest debt, you can pay in and pull out to pay the debt, and the interest returns to yourself will make up for the lack of dump in. Yes, so if you have, say, interest on credit cards, right now I do have some high balances on my credit cards. I bought the farm and then we had to do some renovations. I bought our quote to do the renovations to make it, to bring it up to not only livable, because it wasn't livable. It was a 1920s farmhouse that had a lot of things wrong with it. We didn't have to do a full gut reno. We preserved a lot of the home, but we moved the kitchen, we added a bathroom, we redid a bathroom. So it was a good amount of work. We did an addition to add living space, and then we got quoted for $250,000 for the renovations. I was able to get it done for 50, and so we have about 200,000 in equity that we just created, basically, because that's what it was going to cost us. I haven't got an appraisal, but I'm not going to refinance or anything anytime soon unless the rates drop, and that can knock off some some of the monthly payment for me. But I was able to create that equity there, which grows my net worth. But I do have credit card balances. Okay, so once I pay off the balance using my policies, so right now my money's tied up at my jiu-jitsu school, but quarterly I make payments on one of the policies, and then my other policy, it's due in June. Once I fund those policies, I'm going to be able to take and pay off the credit cards, or if I just want to pay the credit cards with cash, I can do that. But by playing on as banker, what I'm going to do is the same amount that I was going to pay the credit cards, I'm going to keep paying back to my policies. Okay. Sometimes it can get a little bit confusing with like, how much are you paying back and where's the interest going? But in the end, I just want to replenish the policies. So I created a premium that was pretty ambitious for me to pay. So it's literally like a forced savings account. From 2014 to 2019, I wasn't saving. I was just focusing on like investing money and trying to buy flips and make money fast, but I wasn't really saving any money. So my policies force me to put money into them. In total, I think I put in it's about $220,000 since 2019 into policies. Okay, that's forced me to save my money, and then I'm able to access that money and put it to work to make me more money. Okay, so that's kind of the first thing to look at, is using it as your forced automatic savings. And then if we can pay off liabilities like the credit cards, now our money doesn't have to go to someone else. We can redirect that money into the system. Okay. If you pay back the loans and you still have money left over, then you can put that into more premium. You can always check with your money mentor, with Jason, or the company itself. You can call One America and ask them, how much more money can I put into the policy in additional PUAs without creating a taxable event, which we call a MEC, a modified endowment contract. So we want to make sure, and that's, if you guys don't know, that's what happened with life insurance before. People would do what are called single premium policies, where in just the first year, maybe it was a 1 year policy, maybe it's put in 100 grand and let it compound, but the IRS wants their cut. So they put limits on how much money you can put into this, because this, we're using after tax money, so that when our money grows, we're actually not paying any taxes on the growth. Okay. The death benefit goes to our beneficiaries tax free. And if we access it as loans, we're not going to have taxable events from that. Okay. I lied. One more question. What's better, set up a policy on your kid for IBC or on yourself? Reasoning being the policy premiums on kids are cheaper. You cannot put a policy on a child if you don't have insurance on yourself. And the most fundamental piece about life insurance is income protection. Okay. So if you pass away, you want to have that money there for your child. So you want to make sure that you're covered. I understand that you want to have maybe cheaper premiums, but you want to make sure your kids are protected. You also want to, like, you want to do both. You want to try to get the most you can afford on the kid, so that every year as it gets better, you're going to be happy. Hey, I put in this much money. Okay. One thing I didn't want to happen is, get to year 20 on my policy and think, oh, I wish I would have started, I would have had my premium at, 30,000 instead of 20,000 or whatever it was. For my son, I know once he gets to age 20, and his premium is 3,000 a year, he's gonna be like, hey dad, why don't you make it, 6,000 a year so I can put in more money? But instead of kind of getting in my head about it, just be okay with it. This is what I was able to do at that time, and now I can get more policies, whether on him or on someone else. Gabe and Jason always bring great perspectives from the IBC. You've taught me something new today. Shane, I'm glad it helped. We're reaching 3:45. We still got 28 people on here. I'm glad this helped. We just want to give a simple example. But as a practitioner, we're going to use the money and not just let it sit there. And over time, if we can buy right, make good decisions on the things we purchase. And as far as I remember, someone asked about frivolous spending. If you're looking at your money like, well, I have 100,000 in an account that I can put to work, you're probably not going to be thinking of, oh, let me squander it away on some toys, because I know that 100,000 could be making me 15% somewhere as a private lender. Or if you have a business like our painting business, we do 25 to 30% margins. So when we do a project and maybe the materials and labor, it could be, say, $1 million. What we do is we mark it up and we charge the general contractor maybe like 1.3 million. Okay, so the profit is going to be 300,000 marked up from the materials and labor. What I want to get my dad to do, because this is a family business, is set up a policy where he's able to pay for the materials and the labor all from a policy. And then when the general contractor pays him back, he can put that money, pay it back into the policy. Right now, the company has been completely bootstrapped. Never took outside funding or loans. He hates that. And he's just saved all his money so that we can do these big projects. I do estimating during the day, and one of the ones we just got, it's like 2.3 million for a painting job. They're big, new construction commercial apartments, and it's a lot of money moving. And what I want to help my dad do with this is learn how to move all the money through the policies, and do what the bankers do and be able to capitalize on that. Okay, could they have done 150 dump and then no premiums? So that's kind of what I was talking about as a single payment life insurance, a single premium life insurance policy. And it can be done, but it would be considered a modified endowment contract. So then there's different tax implications with that. What the IRS requires is called the 7 pay rule. So that 150,000 would at least have to be distributed within the first 7 years. Okay. That's other things you can do to make the policy work, is add some term, but I'm not going to get into that. right now. Okay, that's something talked about with Jason, and he can definitely let you know if you can do 150,000. Yep, no problem. But like I said, every year the cash on cash is going to get better. So you're not going to want to stop paying premiums unless it's something like you're setting up for maybe a retirement policy. The one I set up for my retirement, um, it's paid up at age 65. So I will be paying for about 30 years and then I stop paying. But my other policy was, which was my first one, that one I don't stop paying. It goes until 121. Okay. So that's kind of my goal is maybe I can outlive it and take that money. But the way we learn how to use it, I will have already pretty much used all that money to to buy assets. And my goal, to be honest, is number one, I want to have a successful jujitsu school. I want to have at least one good one. And as I kind of master a system for running the school, I can maybe open more. Our federation is, or sorry, our affiliation is called Six Blades Jiu-Jitsu. We have about 50 schools around the world. One of the one of the black belts who owns a school, he's been at it for a little bit longer than me. Him and two other guys, they're now at 9 schools between the three of them. They've been acquiring schools, so they got a system in place where the marketing's on point, the sales is on point, and then the delivery is on point. They have phenomenal classes and beautiful spaces. And jujitsu, if you have a qualified instructor who knows what they're doing, and you have good customer service and good at marketing, you can get a place packed out, and really you just need mats. You need, you want to make it pretty, you want to make it nice, but you don't need an intense amount of capital expenses to get the thing open. For me, it cost me about, it's probably about like 20 grand to get my school open. Um, but I didn't own the building. I was renting. So if I wanted to eliminate the biggest expense was just my rent, I would have to own a place, but that takes a lot more capital. But um, if you run a jujitsu school well, you can do 30 to 50% margins. But you need to have it full. And so they're at about 1,000 students, and I think they pay 279 a month for 2 days a week. So 1,000 times 279, you're looking at $279,000 per month that they make gross. And if they're doing 30 to 50% margins, they're getting to keep a really good amount. So definitely over $1 million a year. But they've been at it way longer, and one of them, he's a world champion, so he's got a big name, which helps them attract a lot more people. I'm not a world champion in jiu-jitsu, but I am what I feel like is a very good instructor. So at least I got that going for me. Now I just got to master the marketing and just get better at running the school so I can continue to grow. But that's kind of my plan there. Okay, you guys have any other questions? 26 still here. Well, thank you everyone. Hope you have a great rest of your Thursday.